Arvind, really appreciate you staying up this late and talking to us. Good evening to you, but it's not turning out to be a good evening. The question is, Arvind, we haven't quite handled such ferocity in the fall in a long time. Dips have been bought into. This seems slightly different, doesn't it?
Yes, it clearly is such an unknown and unknowable situation. And given what we've seen so far, the risk is that you're going to see, now you're seeing it obviously in Italy, you're seeing it in South Korea, you're seeing it in Japan, and you're probably going to get it in Germany, and it's probably coming to the U.S., and you're going to see major economic activity impairment as people stop traveling, people stop eating out, people stop going to work, all these kind of things that are going to come. We don't have any roadmap to figure out how much of an effect it'll have, but clearly it looks like first quarter and second quarter are going to be at risk till we get some abatement in the ferocity of this spread. And obviously, as the winter weather recedes, there's some hope and expectation that this is, a strain eventually of a type of flu virus, which should start to, the worst effects should start to abate. But before we can look to the other side, we have the risk that this could tip major economies in the world into a recession. And frankly, with the U.S. election coming up, one of the strongest suits of President Trump has been a strong economy. So it raises questions about the outlook for the election. So there's a lot of things at play here which are causing investors to take risk off.
Yeah, no wonder. And Arvind, just wondering, would you reckon that thus far what we've seen is the risk of money pulling out from key asset classes and key markets? We haven't quite seen the fundamental money questioning what will happen to GDP, earnings growth, etc., because those are still imponderables.
Well, I don't know if I would make that distinction that there's risk off money versus fundamental money. I think everybody has been selling till now. The question really is, when does fundamental money start buying, saying that enough risk has been taken off and values are, or valuations are getting to levels where fundamental long-term investors would be willing to step up. And unfortunately, the market's still at 18 times earnings, so I can't say with any conviction that fundamental investors are chomping at the bit because the market has fallen enough.
Yeah, I mean, this just came because a lot of people in the last few days have also mentioned that, hey, dips should be bought into because this will be transient in nature. But I think Arvind Sanger makes that point well. How do you even distinguish between the two? Seth Freeman joins in this conversation. Said, I think important points made by Arvind Sanger, none not too unknown. But the question here is just this, because this is an unpredictable situation. Do you think that money being pulled out of perceptibly risky assets like equities would continue in the near term until we find some bottom to this issue fundamentally?
Yes, unfortunately, I do think that's going to be the case, because there's fears about to what depth this is really going to turn into a pandemic. We've now seen some cases in the United States. One of the first ones is in Sacramento, California, and this makes investors nervous, but it's also easy to see direct impacts on the economy, especially if you're in the U.S. automotive business, where or construction, where such a large percentage of construction materials are imported from China, and this has direct consequences on the U.S. economy.
It does. Arvind, it's a fair point, right? Thus far, people have been bothered about any supply chain linkages to China and those businesses having an impact. Would you reckon that even from shores like India, businesses which have a large exposure to the US now too might face fundamental concerns about what their numbers could look like over the course of the next couple of quarters, or is it too much to think about right now?
Well, if you're talking about India, the idea that coronavirus will not come to India is I think a wrong one.
Yeah.
And so I think India seems to be woefully unprepared. I've not heard anything. There's so much more focus about all the stuff going on in Delhi. that there doesn't seem to be any focus on coronavirus and preparation for it. And therefore, I think the problems are going to be more, more about Indian companies who will be affected and how will the Indian economy react to it. But I think global supply chains, everybody's going to suffer. For the U.S. economy, I think one of the things is the largest component is the service industry. And the service industry, it's not just supply chains from China, but it's going to be services in the U.S., some of which people will not be using as much. So that could cause real pain to the employment market.
Okay, Arvind, so just before we thank you, what's your sense? I know it's difficult to predict, but still, I have to do this. I have to ask you this question. How much more pain do you foresee right now? And your answer could be completely wrong because it could get even further. But as things stand with the information that you have at hand, how much more pain do you see for equities?
I think, I could easily see this going another 5 or 10%. But that may not all happen as quickly as the last 10% has happened. I think this may spread out for a while till we get a better sense of what's happening. So I certainly wouldn't say this is time to jump in with both feet and start bottom fishing.
Okay, that sounds wise. Arvind Sanger, thanks so much for joining us and giving us that perspective. Seth, Freeman, the other point is, as somebody made it the other day, that bond markets usually tend to price riskier times much better than equities, and we've seen treasury yields show that. And therefore, by virtue of what the bond markets have done alone, and the murmurs around how money is, of course, flying out in India, has seen a large FI sell number in trade yesterday as well. And thus far, we haven't even shown any kind of impact from coronavirus. Would you reckon that this pain of money getting pulled out and at a fast clip might continue?
Yeah, when you have negative money flows from emerging markets, it really affects because of the smaller floats and liquidity. It's going to have a greater effect on emerging markets and India. One of the problems is that is actually the growth of index stocks. So if someone is selling an emerging markets index, and part of it is they're getting out of because of China or whatever, it impacts the allocation of Indian stocks, for example, to that index. But in the near term, I can see this getting significantly worse over the next few weeks, just because of the unknowns. And as you mentioned, if it begins to break out in India, you have such high concentrated populations that it could spread very easily.
One certainly hopes that doesn't happen. I'm not just saying this as an Indian. Yeah, I'm just saying this from a perspective of the human cause. And you're right, the concentration of population might make it a difficult piece. But thus far, touch wood, India has not seen any major cases. One final question, Seth Freeman. Then, what about the ancillary hits to commodities or the ancillary benefits to commodities like gold? How do you see that shaping up? Because gold is at highs, crude is at multi-quarter lows. What happens to both of these?
Well, gold's a safe haven. Treasury bonds are a safe haven. And so that's where investors are going to be looking. Certainly, stocks that are involved in tourism, transportation are going to really suffer. But, one risk here is to what extent this negative sentiment sort of snowballs and pushes the market further down because of triggers and so forth. And that I think is a real risk if we continue to see drops, sharp drops.